So let's get right into this report, Joel. So mortgage rates, you say here, expected to stay above 6% in 2026. Your forecast, Joel, if I have this right, is 6.3% average mortgage rates next year. Let's start there, Joel. Why do they stay above 6%, Joel? And what does that mean for affordability next year?
Really, we see 2026 as a year of steadying across a lot of dimensions of the housing market. Mortgage rates are one piece of that. We expect the Federal Reserve's cuts in December to already be priced into the market, and we expect stability going forward with how monetary policy is handled and how the housing market responds. And so I think this mortgage rate stability is really welcome news for folks who have been on the sidelines for the last couple of years, unsure of whether they can get into the market or not because of how volatile rates have been. So we expect 6.3% average throughout 2026 and ending the year at 6.3%.
And affordability, it improves, Joel, you think, so I have this right, because you think incomes will rise faster than prices?
That's right. We project prices of homes to rise at about 2.2% over 2026, which we think is going to be a little bit below inflation and a little bit below income. So real and adjusted price of homes will actually improve a little bit in 2026. And the improvements in mortgage rates from this year's average, which is about 6.6%, play a part in there as well.
Home sales, you point out here, Joel, they hit a 30-year low in 2024. You think they improved slightly this year per your forecast. What happens in 2026, Joel?
2026, we're projecting a 1.7% increase in home sales, getting up into the 4.1 million range. Still pretty subdued from what a couple years ago were, but not down to the 30-year lows that we've been seeing in 2024 and 2025. So really, it's a little bit more of the same, just slightly steadying and a modest improvement in home sales volume. What
about inventory, Joel? I'm curious what you forecast next year. Are buyers going to have more options?
Buyers will have more options. Across the country, we project an 8.9% increase in the number of homes for sale. And this, of course, isn't uniform across the country. In different pockets, in different markets, we'll see inventory rising and falling at different rates. But overall, more options for buyers to choose from, less competition, so more negotiating power for buyers.
You point out, Joel, I mean, there are regional differences. Are there certain regions of the country, Joel, you all expect to outperform next year?
A lot of our strongest markets are in the Northeast and Midwest in terms of projections for 2026. These are places where we expect sales volume to grow and prices to grow because inventory is more constrained. While in the South and West, inventory recovery has been a lot stronger. There's more new construction activity, and so more competition among sellers will keep prices a little bit more affordable and attainable, while in the Northeast and Midwest, we expect more growth.
So some improvement next year, but what are the factors, Joel, the biggest factors that you think would be holding the housing market back? I mean, would it be, is it rates? Is it prices, the economy? Walk me through it.
Rates and prices are for sure to blame in terms of what's holding the housing market back this year. But really, I think uncertainty surrounding the economy in general is really holding people on the sidelines. People who are worried about their jobs are not looking to make giant purchases like a new home. And so I think anything that can be done to assuage those fears and build up consumer confidence will really go a long way in boosting the housing market in 2026.
A question for those who rent, Joel, and maybe watching this. You say rents expected to decline slightly by 1% next year. You say, a question that's sort of astral, is renting more financially attractive than buying? You'll hear that put out there. That's a discussion point. As an economist, how do you try and think through that? What are the variables?
The most important things to think about are the time horizon and whether you consider being able to live in your investment valuable or not. Based on our price projections, that putting money into the S&P and renting might be a good way to get returns on your investment, but getting your foot in the door for home ownership is important for renters too. It's been especially difficult for first-time home buyers in recent years with mortgage rates remaining high. Those who don't have equity from an existing home have to save up what they can from their paychecks to make a down payment on their very first home, and that's been a challenge. So I certainly don't blame anyone who decides that renting is the right thing for them right now, but this should be another year of rent declines and a good time to save up for a down payment in the future if that's what your goals are.
Fine, Joe. Just talk to me about the role the Fed plays here. The expectation is, the cuts continue. How does that play into your forecast?
Right. Our forecast is mostly built on economic inputs like GDP for the various locales that we look at in terms of employment, because the labor market always underpins the housing market. But the Federal Reserve is something that we keep an eye on, how they're behaving and what we expect out of them. Like we said a little bit earlier on the show, that the December rate cut is pretty well priced in already. But we're interested to see what the chairman and the FOMC has to say about the longer term projections for rate cuts and whether those will give mortgage rates room to even get below our projections. You know, we're in the business of selling homes, so we'd love to see those rates come down.